Hi, before we get started on the ratios, I wanted to do a quick video to update you on the Pro Forma Practice with Ratios template. One thing that's important to me when you leave this course, I want you to have a good solid template that you're familiar with that you could use to build a model in the future. And that template I think is going to be Pro Forma Practice with Ratios. Hopefully all of you are very familiar with the old version of Pro Forma Practice, but this version has a little bit of update in it, as well as some ratios calculated. So let's talk about the update. The income statement, I have reformatted some of these indentations and names, mainly to match what we saw in the 24 group projects we did. I've also added this row 12 for EBITDA. I think one of the videos had it down at the bottom, but it fits logically right here, so I'm going to put it there. In order for it to fit logically, it needs to precede depreciation. A lot of times when you see a company publish an income statement, they'll have depreciation perhaps down here below interest, and makes it really tough to find a logical place for EBITDA. But I have put my depreciation right here, and would recommend if you're dealing with a company like that, you rearrange it as well so that you can calculate an EBITDA and then an EBIT and then move on. I've also made 3 lines here just to drive home the point that we need interest expense and income to get to net interest expense. And I thought if I put all 3 of them on there, then people will be more likely to feel the need to populate them all. That gets us to earnings before taxes. Don't confuse EBIT here with EBIT. This is what people in industry mean when they say EBIT. I've also called profit after tax net income, since that's the way that virtually every company publishes it, even though our books don't always say that. And I've added both a basic and diluted share count. So hopefully nothing surprising there, but something maybe a little bit more useful to use in the future. Also, in our template, calculated dividends as a payout ratio, the way that we did with the original Pro Forma Practice. But I've also included a dividend payout per basic share, because a lot of companies like to keep their dividends constant per share, so that if I make an investment, I can predict, or I can expect that dividend when the quarter rolls around. And so I'd recommend calculating both of those ratios and seeing which one is more consistent for your company, and see if you can find what their dividend philosophy is. And then I've also included this row, basic shares as a percent, diluted shares as a percent of basic shares. If that's greater than 100%, say 102%, then that means there are a couple of percent of the shares that are owned by corporate management as options. For the balance sheet, I've shown a little bit more detail, mainly so we can do the cash conversion ratio. I've shown inventory and accounts receivable separate, then other current assets. And then for total current assets, I've specifically put on the template that excludes cash. I can't tell you how many project models I saw where total current assets included cash. And normally that would be the case in an accounting class, but in a modeling class, we keep that cash separate from our total current assets. I've noted that gross PP&E or gross fixed assets and net PP&E or net fixed assets are the same thing. So hopefully that's helpful on the template. Similarly, on the other side of the balance sheet, I've kept out accounts payable for our cash conversion cycle we'll get to here in the next video, and then other current liabilities to get to total, and again have said excluding debt. So we have a total liabilities and a total equity. I would just mention that most of the ratios below that I'll get to in a moment that say debt to equity or debt to capital really mean total liabilities instead of debt. Now don't let this throw you. Instead of calculating accounts receivable as a percentage of sales, I've calculated them as days of sales. For the same reason, I've done inventory as days of sales and even accounts payable as days of sales. I don't think anything else on there has really changed. The only thing that changed on the consolidated statement of cash flows is I renamed profit after tax as net income. I specified that these current assets and liabilities are excluding cash and debt, respectively. Again, on free cash flow calculation, net income, assets excluding cash, liabilities excluding debt. Nothing else changed. Nothing at all changed in this section. And I added a ratio analysis section. So in the next video, I'm going to talk about cash conversion cycle. In the one after that, I'll talk about DuPont analysis. But meanwhile, I've added some miscellaneous ratios here. Debt to equity, debt to capital, earnings per share growth. and market price of equity. In case you don't have an historical price, I would just use a PE ratio of 15 or something, multiply net income by 15 to get an estimated market price. And then enterprise value divided by EBITDA, that's how many years of EBITDA does our enterprise value represent? That's a very common metric to look at. So these are miscellaneous, not a lot of excitement around those. DuPont analysis and cash conversion cycle will make up the next videos. So look at the blank, look at the complete. This would be a good one to be comfortable with, and again to save for your future reference. Thanks, and in the next video we'll talk about cash conversion cycle.